Welcome, ladies and gentlemen, to our live virtual roadshow from Swiss Resource Capital. And today we have Sibanye-Stillwater with us, the world's largest platinum palladium producer and the number 3 in the world for gold. And James Wellsted, whom you are already seeing here, is the head of investor relations worldwide of the company. And a very warm welcome to South Africa, James. How are you doing?
Yeah, thanks, Jochen. All well. I mean, obviously, we are dealing with a third wave of COVID, so it's a bit tough in the country, but we are doing very well. Thank you.
Okay, super. At least you guys are safe and healthy, I would say. And as far as I know, your company is also doing a lot to fight COVID for your employees, but I'm pretty sure you will talk later about this on the social aspects. First of all, because we have approximately 70 to 80 attendees here, which are registered, and they are now all checking in. So let's give it 1 or 2 minutes. Let me do some remarks first before we start. My name is Jochen Steiger. You know me all. I'm the founder and CEO of Swiss Resource Capital and also the founder and chief editor of Commodity TV and Rohstoff-TV. Very warm welcome also from my side to this excellent live roadshow here today. And I have a very good feeling that it will be of a lot of interest here for you guys. I'm a shareholder of the company and I'm a real happy shareholder because I had the big luck to buy very cheap in the beginning. And before we start, let me do some legal and disclaimer remarks here. Also, we are fully complying to the European data security law, also to Switzerland and Great Britain, so nobody can see each other and also no emails or names are displayed. Please use the chat function to type your questions in, as we want to have like a 20-25 minute presentation with James, and afterwards we love to have a very good Q&A session for a good half an hour with James. Yeah, and I see still people are checking in here. That is great. And yeah, I would suggest that we slowly but surely get started here. And I would say, James, the floor is yours.
Thank you, Jochen, and thank you to everybody who's dialed in. It is a great pity that we can't do this live, but I think we're all affected by the same circumstances, and I hope everybody's healthy and well and safe at the moment. I'm going to give a very brief presentation on the business, where we've come from and how we positioned at the moment, and then, as Jochen said, we can move on to more specific questions. So, as you can see from the header, well positioned for ongoing value creation. We've got a history of value creation, and we think that we've positioned ourselves in the right place from a strategic positioning to continue adding significant value to our stakeholders. Just up front, the usual disclaimer, because there might be forward-looking statements, so please keep that in mind. Just for those who might not be that aware of who we are and what we're about, this is a high-level overview slide. We're listed on both the Johannesburg Stock Exchange and the US Stock Exchange. We've got an ADR program there. Trades very, very well. Market cap of about $12.4 billion at the moment. Net cash position. And I believe it trades very well in Europe as well. Our assets are spread across the world. We've got precious metals. We're one of the leading precious metals companies in the world, with significant gold exposure in South Africa, a PGM business in Southern Africa, and then a leading and high-quality PGM operation in Montana in the US. And then we also have exposure to high-quality projects across the world, lithium project in Finland, and then some copper and PGM projects in Canada, and then in Argentina as well. A very big business, reserves of 82 million ounces, so very long life, and that's only 17% of our total resources. As you can see from the pie chart on the left, you can see how the South African PGM reserves are about 50% of our overall reserves. Gold is where we started, is a lesser part of the portfolio, but still has quite significant life ahead of it. In terms of contribution to adjusted Ebitda or earnings, Again, because of the size of our South African PGM business and, the very robust PGM prices that we've experienced in the last couple of years, you can see that our earnings are dominated by PGM, with gold only making up about 16% in 2020. This is just to give you an idea of our value journey and how our strategy has developed. So at the bottom, we call this our value sigmoids. And you can see at the bottom, started off as a South African gold company. We were unbundled by Gold Fields in 2013. And in the last year, we've really developed a leading diversified global precious metals business, grown from about $1 billion when we listed in 2013 to about over 12 billion currently. Initially, the value that we created, which you can see in that bottom chart, number 1, was through restructuring and cutting costs, significant costs at our gold operations that we inherited from Gold Fields, which enabled us to increase production and extend the lives. And these assets were very, very cash generative in the first 5 or so years that we owned them. And that enabled us to pay down all of our debt in the first year, and then position ourselves as an industry-leading dividend-paying company. So we maintained a 5% average dividend yield, which was more than double our peers in the gold industry, up until 2017, where I'll talk about our acquisition that we made in Montana, the Stillwater mine. We, however, realized that our mining assets were quite mature, our gold assets in South Africa. They're quite deep and relatively high cost, and that in order to create a sustainable business and sustain that industry-leading dividend value proposition, we needed to look for growth by long assets. Opportunities in gold were quite limited at the time, so we saw an opportunity in the PGM industry, which was in severe distress after the global financial crisis because of an oversupply of PGM metals into a low demand environment and low prices. So as a result, these mines were trading at extremely low valuations. So we indicated our interest to move into the sector in 2014. We eventually completed our first acquisitions in 2016. We acquired Aquarius, and then from Anglo Platinum, the Rustenburg operation, which were adjacent to each other. Through integrating these assets and consolidating them, we managed to unlock 1.2 billion of annual cost savings, which changed their fortunes, brought them back into profitability, and positioned them to generate significant cash flow once the PGM prices recovered. Remembering that at this time, 2016, PGM prices were at significantly low levels. Rand prices were sitting at about 13,000 Rand per ounce, and we're currently sitting at over 45,000, so significantly higher. We then took an opportunity to acquire Stillwater in Montana. It's a very high quality, high grade palladium, mainly a palladium project, the biggest producer of PGMs in the US or North America, and also a leading recycler of PGM metals. It was a big acquisition. It was $2.7 billion. We were only a $2 billion market cap company. So it was a big move and quite a bold move, but we were very clear that we could see upside in the PGM prices, and we wanted to diversify our portfolio away from South Africa and acquire an asset that was sitting at the bottom tier of the cost curve. They were also developing a project called Blitz, which would increase production by 50%, and that's currently continuing to develop that. So it's been a very, very positive acquisition. We took on a lot of debt though, and it took us about 3 or 4 years to repay that debt, but we have finally done that last year in 2020, and we're now in a net cash position, and we resumed our dividend last year and paid, again, a 5.3% dividend yield. So again, industry leading dividend. We are now looking at growth in, a future potential to create further value in the clean energy space. Clearly, there's been a big shift towards clean energy and awareness of climate, etc. So we recently made an acquisition, a lithium acquisition in Finland, and we're looking to grow that business, the battery metal exposure. We already have exposure to the future hydrogen economy through our PGMs, platinum and some of the lesser PGMs like ruthenium and iridium are going to be key to that hydrogen economy, which looks like it's going to be quite substantial. But we are looking to grow our battery metal position and other clean energy. We've got significant reserves of uranium sitting on surface at our gold operations, over 80 million pounds of uranium that can be mined when prices are right. And we do think that that's a positive outlook, and we'll opportunistically look for further growth in coming years. In terms of ESG, I think everybody's aware that ESG is becoming a primary focus for investors and companies across the world. And we need to ensure that we achieve ESG excellence if we're going to maintain or attract investment interest from generalist investors globally. So we already, as I said, have got exposure to the hydrogen economy and green energy through our PGM metals that we produce. And you'll see there where they're used already in exhausts to clean exhaust gases and convert them into more benign gases. And then in future, we'll have a significant role in creating or converting water into hydrogen energy, and then again that hydrogen into energy to drive fuel cells to drive cars and supply energy to industry and other. We are also one of the largest global recyclers of auto catalysts. As I said, we recycled 840,000 ounces in 2020. That's at our US PGM operations in Montana. And this is going to be a key area going forward, because as you can see there, recycling emits 6 times less tons of carbon dioxide, uses 63 times less water than mining, and generates 90 times less rock waste. So I think with the focus on the environment, etc., that is going to be a key area for us, and it's a key differentiator given that we're the largest producer or mining company and largest recycler of those metals. And the recycling obviously has green credentials, which will result in lower cost of capital going forward, and perhaps a premium for that metal. We've made a commitment recently to achieving carbon neutrality. This is obviously a big focus. We are currently defining exactly how we are going to get there, but we know we can achieve carbon neutrality by at least 2040. And that will mean that, we will feature on most of the funds' ESG radars, will be acceptable for investment for global funds. We are currently developing a number of renewable plants, so photovoltaic plants, a 50 megawatt that we're developing at our gold operations, and we're looking at another 200 or 175 megawatts at our PGM operations in South Africa, and also a 250 megawatt wind projects. So this is somewhere an area that we're focusing on significantly, and we are confident that we'll be able to achieve these emissions targets. Focusing on our safe production and operational excellence. This just gives an idea of the evolution of the company really since 2016, when we first made our moves in the PGM sector. You can see on the far left of that graph, H1 2016, the first 6 months of 2016, we effectively were only a gold company, and the dotted line is our net debt to adjusted Ebitda, so an idea of our debt and gearing. And you can see we had very, very low debt at that point. We then started to grow the business, and in H1 2017, we acquired Stillwater, as I said, using bridge financing, which we later refinanced through rights issue, corporate bonds, a stream, etc. But you can see on that dotted line how for a while we carried elevated levels of debt, and that resulted in us attracting or trading at quite a big discount in the market to our peers. We then had a number of operational issues at our gold operations, strikes and some safety issues in H1 2018, which resulted in our gold operations generating losses, as you can see in the first half of 2019. But fortunately, we had already acquired those PGM operations, and those enable us to carry through that very difficult period. When that strike ended and we concluded the Lonmin acquisition, you can see H2 2019, how those earnings increased significantly. The gold operations went back into positive earnings territory, and you can see how the gearing started to drop as we started to reduce our debt. And through COVID, even with significant operational disruptions, lockdowns in South Africa, we were able to continue that deleveraging and grow our earnings, resulting in us then resuming our dividend and ending the year in a net cash position. So going into this year, after the operational disruptions, we normalized our operations, even with COVID disruptions and protocols. We reached normal levels of production by November and last year, and that's continued into this year. And you can see how significant the significance of stable operations with the higher PGM and gold price that we experienced. Our earnings in Q1 this year were 1.3 billion. In 2020, for the full year, they were 2 billion. So given that we paid a $1.2 billion or a dividend 100 cents per ADR, or 1.3 billion dividend last year. I'm good, my numbers. 729 dollar dividend. The potential for this dividend to be significantly higher this year is, it's almost certain that it'll potentially be even double what we achieved last year. And our share price is trading at relatively the same levels as we did last year on average. So the yield will be double digit potentially. Just an idea of our assets. You can see the gold assets are the shortest life, but still, 10 to 13 years at our existing assets and 20 years at the projects we're developing. Our PGM operations in South Africa are very long life compared to international standards. And the US operations, again, 25 to 50 year life at those operations. So significant business here. The outlook for our South African PGM operations, but you can see the impact of COVID last year. So on the top graph, lower production, and on the bottom graph, we were unable to spend all of the capital that we had budgeted for. So we are doing a little bit of catch up on the capital this year, which means that costs are slightly higher, all in sustaining costs. But you can see how production is now normalized. And as that capital reduces from next year, we expect flat costs and very, very strong earnings and cash flow from this business. In North America, that Blitz project I spoke about was impacted by COVID and some other operational issues that they experienced in 2019. So it has been delayed by 24 months. It will be reaching full production of 300,000 ounces by 2024 now. Initially, it was targeted for 2022. And you can see the black bars there on the right is the capital that we'll be spending. So over the next 3 years, that capital will reduce significantly from over 150 to 200 million this year to nothing in 2024. And that will mean an additional 150 to 200 million cash flow, obviously. On the left, you can see that as production ramps up at Blitz, obviously the overhead costs per ounce of production reduce. So our all-in sustaining costs are expected to come down by about $100 per ounce to stabilize at about $750 per ounce. So we'll have less capital and cash flow coming from that. We'll have more production, so more revenue, and costs will be lower. So the outlook for this operation is very positive. Again, you can see on the right, that gives an indication of our all-in sustaining costs and all-in costs in red on the top. As the capital reduces, the all-in costs approximate the all-in sustaining cost at about $750 per ounce. Going to the gold operations, again, these are mature operations. We've got a little bit of catch-up capital next year, but production on the top graph has normalized. There is a slight decline ongoing for the next 10 years as the older mines start to close. But because our capital that you can see on the bottom graph starts to reduce quite significantly, our all-in sustaining costs actually decline and stay relatively stable over the next 4 years. So that's also a very positive outlook for those gold operations. Precious metals markets, this is a key question that we deal with investors. The PGM prices have been extremely high, and there's a lot of questions about how sustainable these prices are, what the outlook is near term and long term. So our view, fundamental basis, is that all of these metals the outlook is very positive. You can see with platinum in 2021 we expect a big surplus as the South African operations operate normally. Last year was heavily impacted by COVID and operational issues at Anglo Platinum, where their processing division was knocked out twice in 1 year. But this year, we should see more normalized production from South Africa, which produces 70% of global PGMs. And as a result, there's a surplus in platinum. But going forward, you can see how we anticipate that a steep decline in that surplus going into a deficit by 2025. And that's due to two reasons. First of all, supply from South Africa is peaking and will be declining over the next few years. And that's because of the state that the industry was in financially up until recently. There was very little capital invested in replacement or growth. So as a result, we see that production now declining. And then recently, BASF, which is a chemicals company you probably know about, announced that they'd successfully tested, and we sponsored this research, substitution of palladium, which is used in gasoline auto catalysts of gasoline-driven cars, with platinum, which is primarily used in diesel cars. And over the last couple of years, palladium has significantly outperformed platinum because of you remember the VW Dieselgate scandal and the regulatory shift away from diesel, primarily in Europe, to gasoline and battery vehicles. So with the substitution coming through, there's increased demand of up to 1.5 million ounces out of an 8 million ounce market for platinum. That's quite a significant shift. And as a result, we see this metal going into deficit. So this is where the most upside is in our view, and longer term will be supported by the hydrogen economy and demand for platinum in electrolyzers and in fuel cells. Palladium, on the other hand, has got an opposite story. In the near term, it's very well supported because it has been in deficit for some time and remains in deficit. But beyond 2024, we see supply increasing, mainly from Russia, but also from our Blitz project. So beyond 2025, there's quite a lot of growth in palladium supply and also from recycling. And then from the demand perspective, penetration into ICE sales from BEVs, and then also substitution of palladium with platinum in gasoline auto catalysts mean that this market has probably got the most downside. Rhodium is the big outperformer. You can see the price chart there, how it significantly outperformed anything in the last couple of years, and actually has been a little bit steep. And the reason for that steepness in the last 2 years is because rhodium is essentially only produced in South Africa. 90% of rhodium comes from Southern Africa. The other 8 to 10% coming from Russia and North America. And recycling. But this is where primary supply is. And as I said, the industry has not been investing in replacement production. And we mine a basket of metals. You can't mine these selectively. So with the decline in the overall PGM supply, rhodium supply is also going to decline unless something changes. And that's going to put more price pressure on rhodium. There isn't an obvious replacement at the moment for rhodium in autocatalysts. But what we are doing, again, like the research we sponsored to substitute palladium with platinum, partial substitution, we're now looking at partial substitution of rhodium with palladium, and we're sponsoring that at the moment. If we can get that right, the exchange ratio is about 6:1 to 8:1. So for every unit of rhodium in an autocatalyst, you'd need 6 more units of palladium or 8 more units of palladium to achieve the same outcome. So what that would do is, going forward, you'd get less pressure on the rhodium market in terms of demand and supply pressure, and palladium would see additional demand as a result of that, which would result in a much more balanced and smoother and less volatile basket price, we think, going forward. So that's what we are doing to ensure appropriate market development. Just looking at financial results, I'm not going to talk about the numbers last year. I think that's already in the market. I'll talk a little bit about our capital allocation, which is obviously a big issue. Up until last year, we were primarily focused on paying down our debt and resuming our dividend, which, as I said, we achieved last year. We're now in a net cash position, and as a result, we've been able to commit to investment in sustainable production at our PGM and gold operations in South Africa. These are very, very high quality, high return projects, which had already previously been, largely developed by previous owners, Lonmin at K4 and at Burnstone Great Basin Gold. So because of that, the capital that's required to finish them is relatively low compared to our peers in the industry, and we get into production within a year at most of these projects. So as a result, the payback is within 4 to 6 years. And for instance, on K4 at current basket price, it's over 80% internal rate of return. So an extremely, extremely high quality project. Given our experience recently with a lot of debt and some of the operational disruption, which created a lot of issues at the time and added to the risk profile of the group, we want to build a cash reserves of about 20 billion rand, which would be about $1.3 billion. My maths is not on. But we want to maintain that level of cash, and we've already got that. So it won't be maintained at that level strictly. It'll go up and down depending on dividend payments, taxes, etc. But that's the level that we're targeting to give us obviously a buffer against any uncertainty or disruption, and also some opportunistic, if we see opportunities, we can utilize that cash quite quickly. Dividends, as I said, our investment proposition is that we are a leading dividend company in the industry, and we want to maintain that. We have maintained a 5% dividend when we've paid it. Only a 2 or 3 year period when we had the debt did we have to suspend our dividend. And in fact, last year's dividend of $729 million was actually larger than our market cap when we listed in 2013. So we essentially paid back in 1 year's cash flow or portion of cash flow our entire listing market cap, and we will maintain that dividend. We also will further refinance some of our debt. We've got 2 bonds, about $700 million in total, and we're probably going to call the June this month. We'll call the 2022 bond and reduce our debts in that way, and maybe in future refinance those bonds at much better rates than what we achieved in 2017 when we listed them. Our focus is very much on returning value to shareholders, and any surplus cash that we generate, we will obviously return to shareholders. And in that regard, in the beginning of June, we announced a buyback, essentially $700 million buyback that will take place over the next 9 to 10 months. 5% of our shares in issue, and in that way we'll continue to give value back to shareholders. At the end of the year, we'll obviously review our position again, and if there's additional cash or surplus cash, we'll look at special dividends or further buybacks at the time. So that's really where we see our capital being allocated. Obviously, it doesn't preclude further M&A growth. We can achieve that. We've got a very robust balance sheet. We're a much bigger company, no debt, and with a very good cash flow outlook. So we can quite easily accommodate our M&A growth aspirations. And as I said, we're looking in the green economy space, so battery metals, and we have also spoken publicly about potentially growing our gold portfolio again to create more balance between gold and PGM earnings. As you saw from the previous chart, gold is now less than 20% of our earnings, despite it still being quite a substantial business. Just quickly on the K4 projects, I spoke about the quality of that project. You can see the prices that we used, significantly lower than current spot and very conservative. But even with that 3.9 billion rand investment over 8 years, NPV at a 15% real discount rate of 3 billion at these assumed prices and 21 billion at spot, and an IRR of 33% at conservative prices and over 80% at spot. So very, very high return projects. And you can see the capital expenditure profile, 50 years life, will employ over 4.5 million people and create significant value for other stakeholders in the area.
Probably 4,500 people.
That's right. So, as you might know, Marikana's got quite a tragic legacy with the Marikana tragedy that happened in 2012. So what we're doing is now reinvesting in the future of Marikana and creating more opportunities. And we've got a social program called the Marikana Renewal Program, where we're trying to address those legacy issues that resulted in that tragic outcome in 2012. On the battery metal, I'll give you a little bit of detail on the Keliber. It's a relatively small first step into that area. It's a good quality project, mining lithium and then converting it into battery grade lithium hydroxide. We acquired 30% initially for 30 million euros, and we can increase our stake to over 50% if we finance a larger part of the project capital. What we like about this project is, first of all, we'll get exposure to that technology, upgrading the lithium to a high quality lithium hydroxide, but it's really about the location and geography. Finland is a very investor friendly location, top 5 in the Fraser Institute from an investment perspective. And the Finnish government has publicly stated its intention to grow that region into a battery hub, delivering battery metals into Europe to end users in Germany, France, etc. So that is what they intend doing. So they're very supportive. And because Finland is mostly hydropower energy, it's also got a very low, very positive carbon footprint or low environmental footprint. The closeness to the end user markets is also critical, because you can imagine a lot of lithium projects in Australia, Chile, having to transport that lithium is challenging, first of all, but also transporting it long distances to Germany, etc., adds significantly to the carbon footprint of each ounce of that metal, whereas ours will be very low carbon footprint and in theory might even achieve a premium in time. So we'll be using our existing networks, marketing networks for PGMs to build those relationships and deliver to the end users in Europe. Another key point is that one of the big shareholders there is a group called FMG, Finnish Minerals Group, which is essentially the entity that the Finnish government holds its interests in these projects and mines in Finland. And we already had to pass through quite a lot of scrutiny to be chosen as partners in terms of our mining capability and also our marketing reach. And we'd like to build that relationship with FMG and hopefully in future leverage that relationship into other projects, high quality projects, which nickel, lithium and other in Finland and close to Finland where they've got interests. So that's really the strategic rationale there. And we're looking for other similar opportunities across the world going forward. So in conclusion, I just want to show, since our inception in February 2013, we've been through quite a rocky roller coaster ride, as you can see from the share price. But that's because of the quite significant growth and rapid growth that we've undertaken, delivering on our strategy. We've bought a number of companies in a very short space of time and transformed our business into a global or an international diversified precious metals business from a small South African gold producer. And you can see on a relative basis how we've outperformed a lot of our peers. You can see Barrick, a number of the well-known peers in the gold and PGM industry. We've significantly outperformed them and obviously paid much higher dividends. Our dividend last year, despite Barrick being 3 times our market cap, our dividend was actually bigger in dollar terms than what they paid. And they actually increased their dividend payout. And then just talking about value, I mean, this is always a subjective thing, but you can see how on most market consensus metrics, so EV, Ebitda, price to cash flow, our debts, we positive, as I said, and then EV to market cap, we compare very favorable to a lot of our peers. We think as we continue to deliver value to shareholders, that there will continue to be a re-rating, despite the share price that we've achieved over the last 8 years. Our earnings have grown at a faster rate, and as a result, we still trade at very, very low multiples. So, in summary, solid, consistent strategic delivery. We're a leading global precious metals company and very well positioned for the future green economy and for value creation in that space. We are committed to ESG excellence and have been recognized for that. We've got a very, very robust balance sheet and a lot of financial flexibility. We are continuing to invest in sustainability of our existing operations and generating a lot of value through that. We've got unrivaled projects in the PGM sector, and we will be growing our business further in the tech metal space or green metal space, and potentially also in gold if we can find a value accretive opportunity. So thank you. I think on that note, perhaps we can go to questions.
Okay, super. Hey, James, thank you very much. That was a great presentation. So we are back here to normal. Before we start here with the chat, I just want to give the investors a little bit more time to get in. I just did some mathematics, to be honest, because I got a lot of questions about the dividend, as you can imagine, by email, by phone, by YouTube, etc. And I already see it here. So I'm just thinking on an idea. I saw that you want to pay out 25% of 35 to 35% of the normalized earnings. So you had 1.3 billion in Q1. Times 4 is 5.2. Let's stay super conservative and say maybe you can do $4 billion. Okay, 35% of that would be $1.4 billion. That's exactly the double from last year. Is that a little bit of an orientation? I know it's a forward-looking statement, but I had so many questions, so I need to ask again.
Listen, it's difficult to give you a firm answer on that, but what I would say is that, we did pay over $700 million dividend last year, and we were comfortable doing that, even though, we had only just paid down our debt. We have... our operations last year were significantly disrupted by COVID, which isn't the case this year. We're operating normally. And last year, the prices were a lot lower. The average PGM basket price, for instance, in South Africa was about 36,000 Rand per ounce. This year, we're sitting at probably over 50,000 Rand per ounce on average. And even with the recent pullback in PGM prices, rhodium, etc., due to chip shortage and other, temporary factors, we still, got a basket price of over 45,000 Rand per ounce. So, if you look at higher production, higher prices, it's a very good possibility. We are doing the buyback as well. So, but I think you're right. I mean, there's a strong possibility it'll be double-digit dividends. Yeah.
Super. Glad to hear that, because as I said, I'm a long-term shareholder and I'm really happy on that. So that is fantastic. We also saw that you want to call probably the 2022 bond, and you want to do this already now. So you said you want to refinance, but would it make sense, let's say, with your cash strongness, I would call it, just to pay it back and then to get rid of the whole thing? Is that possible?
Yeah, so I think there are two things. First of all, that bond is now trading at par because it's getting close to expiry. So we won't pay bondholders a premium for it. The coupon on that bond is relatively high because we issued it in 2017 to refinance that $2.7 billion debt we took on for Stillwater. So we do want to reduce those financing costs. The 2025 bond is still trading at about a 3% premium. So we'd rather wait a little while and reduce that premium before we cancel that bond or buy that bond back. But I think that, we would like to maintain a presence in the global credit markets. For future, if we do need to go to the credit markets, we've got quite a strong following of credit investors, bond investors who know the company, like the company, etc. So we're thinking maybe issuing about a $500 million bond in future over a longer term, maybe an 8-year term, and we'd get much better interest rates than we did in the past. But that would mean we would maintain a presence in the debt market as well, would be visible, which might be useful going forward. Yeah.
Okay, super. So we have several questions to your valuation, which I see it also a little bit as, let's call it funny, not to blame somebody here, but I bought your stock at €1.10. Today we are at €3.60, and I still think your stock is really undervalued given the fact that what you just presented the last 40 minutes, really. And so the question here comes from several shareholders from Italy, from Switzerland. Why do you think you are still that cheap, also in the light of your dividend yield and maybe upcoming dividend yield? And is that maybe also a function of, let's say, the country risk with South Africa? And also on the other hand, do you think about aggressively diversifying, let's say, more into copper and nickel, for example?
Yeah. Okay. So, I mean, there are a number of questions there, but let's address them one by one. I think, we've always attracted a bit of a discount to our peers. I think initially it was because the assets that were spun out by Gold Fields were perceived as short life, end of life, high cost, very difficult assets. And at the time, the labor environment in South Africa was very difficult. It was a year after Marikana, etc. So that was seen as an issue. There wasn't a big, desire or investment attraction to deep level gold mine assets in South Africa. Yeah. We then obviously went through quite a lot of rapid growth. I mean, in 4 years, we became the biggest producer of PGMs in the world from nowhere. And that meant that the company went through a lot of change. So we were constantly undergoing change, and the financials were very confusing, and predicting earnings, etc., was very difficult. And then, because we also took on that debt with Stillwater, and we had operational issues at our gold operations, all of those things combined to attract a big discount from the market. It's only last year that we actually resolved a lot, or in the last year or so, that we resolved a lot of those issues, paid down the debt, resumed the dividend, etc. So it's been a relatively short space of time. And I think as we continue to show investors the earnings potential of our operations, cash flow generation, and pay the dividends, because there are question marks about whether we will or won't pay, then I think we will see a re-rating coming through. There is also an element, I think, of concern around uncertainty around M&A. We've had a very successful and value accretive M&A strategy in the past, but there is a bit of concern, particularly around the gold, because until recently, gold shares were trading at quite a big premium, and there's a concern that we won't be buying assets at the bottom of the market like we did with the PGM. But again, we are a very disciplined team. We're very focused on value. We've been looking at the gold space for over 2 years now, and we haven't done a transaction because we didn't see the value, and that's exactly the point.
Okay. And what is, let's say, to go a little bit more aggressive into copper and nickel, for example?
Yeah, so, I mean, those metals are definitely part of the battery metals and future metals for mobility, etc., that we've identified. I think nickel is probably a more potential at the moment. Copper, the market's obviously done very well over the last year, particularly as vaccine rollout took place and global economic concerns started to evaporate. So copper's really outperformed, and it's quite difficult to find value opportunities in copper at the moment. But again, we're happy to wait and then look for opportunities at the right time. So I think there's more likelihood in nickel, lithium, and some of the other metals that haven't outperformed the way copper has.
Super. How do you see the situation with ruthenium and iridium?
Yeah, so again, I mean, these are important metals. All of the PGMs are very, very critical metals. They've got very unique chemical and physical characteristics. And again, ruthenium and iridium, even though they're not as high focus as platinum, palladium, and rhodium, we're the biggest producer of those metals in the world, and they are going to play a big role in the future hydrogen economy, potentially in electrolyzers and fuel cells. So in cathodes and anodes on fuel cells, and then also as part of the to catalyze water into hydrogen in electrolyzers. So you would have seen that those two metals have done very well this year already in anticipation of that, and we think that there's still quite a lot of upside. So we're very well positioned for that future.
Fantastic. Then an investor from London is asking, how do you see the mix of gold, PGMs, and battery metals in the revenue stream in 2024 and maybe also a bit beyond?
Yeah, I mean, that's quite a difficult call because it does depend on the prices. I mean, we're quite positive on the outlook for PGM prices. There might be a bit of a moderation over the long term. 4 years or 5 years, it might moderate a little bit from very high levels that we've seen, record levels. But certainly we think that it's going to be PGM prices are going to be well supported. So PGMs are going to be a very big component of our earnings for quite some time. The gold, if we don't do any acquisitions, is going to become a lesser and lesser part of our portfolio because they are mature operations, and over the next 5 to 10 years, there is a natural decline in that production profile. So it is going to become a smaller part of our portfolio. If we do acquire a sizable international gold producer, as we've spoken about, we want to achieve diversification geographically and from a portfolio perspective. We would like to try and buy an international gold company producing over 1 million ounces at least. And that would mean that our gold, if we were successful in that area, we do think that the outlook for gold is quite good, that this quantitative easing and stimulus that we're seeing globally is going to come back, and there's going to be a bit of a post-stimulus headache at some point, and gold does tend to do better in that environment. So gold could potentially be, again, 40 to 50% of our earnings if we can do a value accretive transaction.
Okay. If you would do a transaction, would you pay that, let's say, completely with shares? Would you say, okay, we maybe do a split? Meaning, would it be really dilutive? That's also a question here in the chat.
So again, I mean, I think it depends on the assets and the opportunity. As I showed you, we are trading at quite big discounts to our peers. So we'd have to be very careful about utilizing equity, and diluting shareholders. We are very aware of that. If you look at previous transactions we did, Aquarius we bought for cash because we had cash. Rustenburg was structured in a way where we repay the nominal value over a period from cash flows from the operation. So quite a clever structure to reduce exposure to our balance sheet. And then Stillwater, we had to use huge amounts of debt, as I said, because of the rating differential. Lonmin, however, because Lonmin was trading at such a poor level or a big discount, we could use equity without diluting our shareholders. So again, it depends on the opportunity, and potentially we could use a number of those different capital structures to get value from a deal. But yeah, we're very aware of diluting shareholders and destroying value, so we're not going to do that.
Yeah, I like to hear that. Can you bring, that's a shareholder from Zurich, can you bring some color on your stake in DRD, please?
Yes, so DRD is an excellent business. I mean, they specialized, they were one of the oldest gold companies. It is the oldest listed gold company in South Africa, but they transitioned their business over the last decade or two from underground mining to surface reprocessing. They acquired Anglo Gold's Ergo operations, etc. And they've become very good at that bulk surface mining and then reprocessing, metallurgical. So we essentially, they were running out of reserves a couple of years back, and we had significant dumps that we were looking at developing but didn't have the capital at the time to develop. And we entered into agreement with DRD Gold, where we vended those assets, those dumps in the West Wits, into DRD Gold for shares. So initially a 38% stake, and then we increased that to over 50%. So we're effectively the controlling shareholder. It's an excellent business. They've got very good skills. And what we're looking at is potentially leveraging those skills and growing the business. They are looking at growing their business with our support into maybe not only gold, consolidating further gold, but also maybe into other metals.
Then there is a shareholder, I don't know if it's German or Swiss. What happens to the idea of CEO Neil Frohlman of March to merge with other gold companies? Probably the share price reacted very negative on this idea.
Yeah, so again, I mean, that whole story, I mean, as I said, we've been consistent with our rationale for buying the gold assets. As I mentioned, the portfolio basis, gold tends to act countercyclically to PGMs, which are very much exposed to industrial economic cycles. You saw with COVID in the beginning when the lockdowns happened, all of the metals collapsed and gold outperformed. So we like that counter-cyclicality. And given our position as an industry-leading dividend company, we think that by balancing the portfolio better between gold and the industrial metals, we'll create more consistency and less volatility in earnings through the cycle, which would support that dividend, the ongoing dividend, and sustain the dividend. And then also our gold assets, because they are in South Africa, they're deep level, labor intensive, energy intensive, and we rely on Eskom at the moment for our energy and its coal-fired power. So our carbon footprint on those assets is quite high, and we're on the upper end of cost curves and greenhouse gas intensity curves. By buying a bigger international producer with assets or mines across the world in lower risk jurisdictions, we would reduce our geographic risk significantly. We'd also shift our gold portfolio down the cost curve and down the greenhouse gas intensity curve. And as you know, I mean, with the focus on environment, etc., this is going to become a big issue going forward. So that's the rationale, but that's been the same rationale for the last 2 years. What we were saying in February, March was that because of the gold share pullback, once vaccines started to roll out, etc., the gold shares, which peaked in about September, October 2020, pulled back 40-50%. And we were starting to see value again in that sector. Again, in recent weeks, the gold price popped over $1,800 to $1,900 per ounce, and the shares went up 30-40%. So we pulled back from that again. So we still like the strategy. We see the logic in doing it, as I've explained, but we're not going to do a deal for the sake of doing a deal. If we see value, we'll look at doing it. But you can see our discipline is not to just chase the deals. Yeah.
Exactly. That makes absolutely sense because you are in the lead position, and that's a good thing, in a strong position, right? Then there's a direct question from a Nordic shareholder. What do you want to, or what are your plans with generation mining?
So generation mining, essentially that project we inherited through Stillwater. And we very much focused on getting Blitz up and running. It's a much bigger project. It's going to be huge value. And we had the Altar project and Marathon that we inherited. So our approach and our strategy for those projects has been to partner with juniors who are better at advancing early stage projects like that. And then we've got an opportunity to obviously earn in and increase our stake at a later stage once all of the feasibilities, etc., have been done and the value's been proven. So we're still involved in Marathon and on Generation. We've got a board position, and we're assessing the opportunity as they continue to develop that project. But I can't really comment on it. I mean, we do like it, but we'll have to see how it evolves.
Mm-hmm. Could we just go a little bit overall? You have Generation Mining, you have Denison, Altar, you have Calibre. Could we say that this is, let's say, also a strategy for the longer term possible production then in the future? I mean, Calibre, I have the feeling you definitely want to produce there some lithium, right?
Yeah, Calibre will be in production. It will be producing, they're just waiting for permitting, etc. But it will be producing about 15,000 tons of lithium hydroxide, battery-grade lithium hydroxide by 2024. So that will be in production. And clearly, if those projects you mentioned get to that bankable stage and development stage, we'll then consider how we participate going forward. But yeah, there's a very good likelihood that they will be developed and producing. Our model hasn't been to really develop projects in the past. We've been looking at more growth through acquisition so that we can get immediate or in the short term accretion to our earnings, which supports a dividend. And we've left that capital investment on long lead time projects to our junior partners.
Mm-hmm, super. What PGM prices do you use for your financial planning? And I don't know, maybe if it's an average or whatever. Can you say that?
Yes, and I think if you refer back to that slide that we showed,
I think it was there, right?
Yeah, on the K4 project, you could see that we used for 2021 $900 per ounce platinum, and platinum's at about over $1,100. Palladium we used 1,900. It's over 2,200. Rhodium we used 8,500. And that's, as you know, is about 20,000 at the moment. And then long term, we used 880 platinum, 1,600 palladium, and about 5,650 rhodium. So significantly lower than current spot prices.
Fantastic, super. Then there is a question from Munich, from a journalist. We saw today dealings, insider dealings, of course, in the securities. It looks a bit that there's more selling than buying, but he wants to ask what does it mean? Was it for tax reasons, for example? Is it now the time for investors to buy the stock or to hold?
So I can't give you that advice. You'll have to look at I can just give you the value story as we see it and our strategic. But exactly. Those trades, which look like quite a lot, are related to our long-term incentive scheme, which is a 3-year scheme, and the shares vest over that 3 years in different quantities. And obviously, if you look back 3 years, that was in 2018 when we were having the safety issues. We'd just taken on the debt with a Stillwater acquisition. So our share price was trading at about 15 Rand, I think, at the time. So we get awarded as management according to salary, etc., a certain amount of shares at the price of the day. Those shares have now matured, or that incentive, and we're trading at 55, 60 Rand. So the value is significantly higher. So the executives who then get allocated the shares as part of that scheme, in order to cover the tax, they elect to sell a proportion, which is 45%, is our income tax rate in South Africa. So that selling that's been announced is really selling to pay for tax on the shares, but most of them are retaining the other 55% of the shares allocated to them.
Super. Then there is a question. Do you expect the South African projects like Waterberg, Platzreef, and Sedibelo to be funded and potentially have an impact on the long-term PGM prices, meaning to go in production?
Yeah, listen, it's an interesting question. I mean, they are good projects and attractive projects. I think there's a number of issues. I mean, you would have seen that despite record PGM prices for the last 2 years or more, you haven't seen a huge response from producers. I mean, we recently announced our projects, they're mainly replacement. Impala's announced a couple, they're mainly replacement. But other than that, there's been very little announced. And I mean, Ivanplatz, Waterberg, etc., have been in development for quite a while. There are a few constraints. The first being that the basket price that we talk about in South Africa currently has been driven by the rhodium price. Rhodium's only 8% of the metal we produce in the basket, but it accounted for over 50% of revenue in the last couple of months. Those projects I don't think have a lot of rhodium, unfortunately. They're mainly palladium and platinum, so the basket price for those projects is more dependent on palladium. And then within South Africa, there are other constraints being obviously the political environment, the economic outlook, electricity shortages. As you know, we have load shedding regularly because our state utility, which provides electricity, is unable to provide the required amount. Water is an issue, and then there's social issues. So yes, I mean, the prices are certainly incentivizing the development of those projects, but it's probably going to take a little bit longer, I think, than some might expect.
Okay, super. Then I have a question also from my side. I call it the $1 billion question because you have 100 million pounds uranium in reserves, and nobody talks about it really. So we are getting more and more the impression that uranium is something which would come into the play again. I don't know if it's this year or next year already, but have you already reserved some capital to say, okay, if uranium prices come back? And I remember when we were together on a roadshow, I think it was like 3 years ago or something like that, or 4 years ago, that you or Neil said, I'm not sure, that something around $45-50 uranium you really could imagine to bring this to life, because it is very simple to do so. It's from tailings, right? So you must not build a mine, you just need a processing plant.
Yeah, there's 80 million pounds at our Cook operations, and essentially it goes back to the gold mines. Uranium was associated, and particularly those operations had very high uranium grades associated with their gold reef that they're mining. And the gold producers actually used to produce uranium as a byproduct. But when prices collapsed in the 70s and 80s, what they did was decommissioned all the uranium plants, and they just mined the gold and put the uranium on dumps. And hence why we've got that massive reserve at Cook. And we were looking at developing a significant surface retreatment business, gold and uranium, with our Driefontein, Kloof, and Cook dumps. As I said, we've sold the Driefontein and Cook dumps to DRD Gold, but we've still got the uranium at Cook. And, if the price does increase, we will consider our options. I mean, we could easily fund the capital now. It's we're a much bigger business. When in 2014, when we were only $1 billion, it was an issue funding a project that size. But now it wouldn't be a problem, and it is obviously in our consideration as an energy option for the future. It is green energy. It's clean energy. So we are looking at potentially developing that position.
Also a question according to, let's say, the overall car market, because we were talking about a lot of your recycling business, which is very successful, but this is all combustion engine. You have started now to diversify into, let's call it, the e-mobility sharing here, I would say. And I just got the latest numbers there. It is set for 2021 approximately 70 million cars will be sold worldwide. In 2020 we had a plug-in electric share of approximately 5%. So this might increase also, but still is on a low number. On the other hand, we have states like, I think it was France by 2040, they want to ban combustion engines. England wants to ban combustion engines. I mean, this is nicely said, but to do it is on a, let's say, on a different page, right? How do you deal with those things for the future? How do you maybe adjust your plannings? Do you say, for example, our PGM business, it's fantastic, let's say for the next 10 years, and then we might get a problem? Or what's your strategy on that?
Yeah, so again, as I said, I mean, we've got a substantial long life PGM business. Yep. We do factor in, we know that EV is going to be growing in future. I mean, it is the future. But when I talk EV, it's not just battery EV. I think the media and everybody focuses on battery EV. EV also includes plug-in hybrids, which also have a catalyst and exhaust. There's a combustion engine as well as the electric side, and then also fuel cells. And fuel cells will be more used in trucks and buses and heavy duty equipment, with batteries more suited to cars. So there will be penetration, and it will impact on sales of ICE, but not over a 5 or 10 year period. I mean, politicians can say a lot of things quite easily. Delivering on them is more difficult. You've got to build an extensive electric infrastructure to charge these vehicles. You've got to build additional generation capacity. Where's that going to come from? And then even the battery rollout or growth in batteries, obviously the metals, they're going to require substantial amounts of lithium, nickel, manganese, cobalt, etc. And the point is, at the moment, the best deposits are being mined, obviously, with the lowest costs and highest grades. Over time, as that demand grows, you start to develop the lower quality deposits, which have higher costs. So those input costs into the battery are going to become more and more significant as well. And it's a question of how the mining industry can grow and how quickly to meet that perceived growth in battery demand. So I don't think that those issues are fully factored in. Battery electric vehicles are heavily subsidized. When those subsidies stop, when the cost of the inputs increases, are they still going to be competitive? And at the same time, a lot of combustion engine vehicles are getting increasingly lower and lower emissions. So there's a lot of moving parts, and regulation is driving more towards battery and fuel cells. But again, things can change in time. But we're well positioned, and we obviously see the potential in the battery space, and hence we are already growing in that space.
Super. Last question from my side here, and this is a very special question, and you must not answer if you don't want. I fully understand that, but we have since 2 days the Basel III Accord in play, with the BIZ in Basel, and so it's the bank of the central banks, and I've read a lot on a possible impact, because gold will be moving from as a tier 1 equity asset to tier 3 to tier 1 equity asset. And it is said now that it's no longer that easy to move gold around, because it's like recognized and unrecognized gold. Do you think this might stabilize a bit the gold future trading market, that we will now in the future not see that many, I call it funny movements, to avoid the word manipulation? Do you think that might help the gold price in the longer run?
Listen, I mean, it's difficult to say. I mean, obviously, regulations driving more buying by central banks is going to be positive and support the gold price. There is a bigger focus on all metals, including gold, as to where they come from, how they were produced, etc., etc. So that is going to become a bigger issue. I mean, we are more and more being asked to make sure that we know our clients. We are able to show how the gold was produced, that it was done in a environmentally and social positive way, etc. And we're going to have to start tracking that. And I think blockchain, etc., might be the way to do that. But I agree. I mean, I think it will stabilize. It'll create more support. Difficult to weigh whether there's going to be a shift. The cryptocurrency thing is going to become a competition for gold or not, and how that'll affect it. But we do think that, regardless, gold will be well supported. It's still going to maintain its role that it's maintained through history. And we do think that the stimulus and that we've seen and the amount of liquidity in the money markets is going to result in inflation, and ultimately gold will do well in that environment over time.
Fantastic. Super. So let me double check again here that I did not miss a question. Here we go. Because of the dividends, is there a difference to hold the ADRs or the original South African shares?
Listen, I'm not sure of the exact tax issues in the US, but I do think there are some additional taxes that US shareholders face, because we've certainly when we talk about buybacks versus dividends, US shareholders who hold the ADRs seem to prefer buybacks, or not prefer, but they like the buyback because it doesn't have as much of a tax impact on them. So I'm afraid I can't give you that answer. I can maybe send you a response, Jochen. I can maybe ask about it, but I don't think there's a significant difference between the two, to be honest.
Yeah, I think the only thing is, as far as I understood it from my taxation here in Switzerland, you have with South Africa, it's a 20%.
Yes, withholding tax.
Withholding tax, exactly. And we can claim 15% automatically because we have a bilateral tax agreement, as Germany also has. And I think with the ADRs, you have to sign the W8BEN document with the US, and then you have also the double tax treaty so that you can claim back most of the withholding tax. But this is also a little bit specific if you hold it private or in a company. But I think the difference, as you said, is not really large. Maybe some percent plus or minus, definitely. Super. Okay, so then what have we here? Oh, that's Henrika. We know her. Super. Yeah, people are say thank you already here, and of course some more meetings are going on. So James, also I have to thank you really for a great 1 hour and 12 minutes already, and it was a great presentation. Thanks for that. I'm a happy shareholder. I stay as a shareholder, and I will buy definitely more because my feeling is that the dividend will increase very nicely. So all the best to South Africa. I hope to see you soon. Unfortunately, my feeling is that it might be next year, not this year. And as we still all have travel limitations here with the Delta and Delta Plus mutation, but keep safe, please. Stay healthy. That's very important. And I wish you all the best, and say hello to the team, please, when you are in the office.
Thank you, Jochen. And thanks for everyone who attended. Please stay safe and be careful here.
Yeah, thank you very much. Yeah, ladies and gentlemen, that was James Wellsted, Head of IR and Communication Worldwide of Sibanye-Stillwater. Yeah, the leading, I would say, precious metals PGM company in the world here. And you heard it. They are making money like really unbelievable. They earned already in Q1 almost double than what they paid last year as dividends. And also they are very keen on costs. They are very keen and behind on how they structure the company. They have already made a lot of steps into, let's say, clean tech metals, yeah, like with lithium and caliber, and also generation mining, for example, Alta. And they have, they are on a great way to diversify. They want to build a very solid cash position out here for the future, and they are almost debt free. And what we most like, to be honest, is that we will see a significant increase in dividends this year. I would suggest you really check out this lovely company if you are not already a shareholder, and make sure you grab some, because today the stock is still quite cheap. I wish you all the best, and say bye-bye from Switzerland. Please stay healthy, have a glass of red wine, have a gin tonic. That always helps against COVID, and hope to see you all soon in person. That would be really great. And by now we stay with our live virtual roadshow. So wish you all the best. Thank you very much, and bye-bye.